a good business would always see its share price increase. But in the short run, prices go through market cycles or phases. So any stock, any market will go through three main parts of the cycle. So there's certain time when the price is on an uptrend cycle, like so, okay, where prices tend to move higher in the short run. And then it goes into a consolidation phase where prices tend to move in a sideways fashion. And then there are times it goes into a downtrend where it makes a downtrending move. It goes in a consolidation pattern again over here, and then another uptrend pattern over there. So again, it doesn't always go through these sequence of cycles. It could be on an uptrend and then a downtrend, or a downtrend and uptrend and consolidation. So it's critical when you're trading to know which cycle is the stock or the market in. So let's study the three different cycles. So the first one is an uptrend. So stocks are normally on an uptrend when the market is bullish. So how do you define an uptrend? An uptrend is defined when the price makes a series of higher highs and higher lows. So on an uptrend, price still comes down for a few days. But every time the price goes down, it makes a higher high, right? Comes down, makes a new high. 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 So again, an uptrend is when the stock makes a series of higher highs, as you can see, and a series of higher lows. And when the price is on an uptrend, the probability is that prices will move higher because the market is bullish or optimistic. So on an uptrend, you always want to go long. Okay, you always want to go long on the uptrend because you always want to buy when prices are more probable to go up than to go down. So question is, when is the best time to buy on an uptrend? Would you want to buy at A here or at B here? Once again, would you want to buy at A at this point or at B at this point? Well, the answer should be obvious, B, right? Because you always want to buy as low as possible, right? Buy low, sell high. So you always want to buy at the lowest point of an uptrend, and we call this a dip, right? So prices move in wave patterns. It moves in an impulsive wave. We call this the impulsive wave. And then the corrective wave, or we call it a dip as well. So this is a dip, impulse, dip, impulse, dip. So you always want to buy at the dip. Now the question would be, how do you know where is the lowest point of the dip? How would you know it will not go lower, right? Now you can't know for 100% certainty, but you can make a pretty good guess because whenever the price makes a dip, it tends to find support at one of the moving averages. So in this case, you can see I'm putting in three really major moving averages: the 50 moving average, which is the blue line, the 150 moving average, the green line, and the 200 moving average, which is the red line. Okay. Now, different stocks tend to respect different moving averages, and moving averages act as levels of defense. So in the stock trading and stock investing course, in the lessons to come, I'll talk more about which moving averages to use for different stocks and for different time frames. So you can see in this case, on the uptrend, when price moves up and it gets a bit too far from the moving average, it will retrace to the moving average. Goes up, retraces, goes up, retraces, goes up, retraces, goes up, retraces. So whenever the price gets very near the moving average or it bounces off the moving average, that is the optimal time to buy. So we always buy the dip on the uptrend. Okay, so this would be a buy point over here. This would be a buy point, and this would be a buy point when it bounces off the moving average. And this is also known as buying on the retracement. Okay, buying on the retracement. What you never want to do on an uptrend is you never want to buy at the high. Okay, never buy the highs of the uptrend. Why? Because when the price goes at a high, eventually it would have to retrace back to the moving average. Okay. Now, will there be times when there are traders who sell on an uptrend, where they go against the trend? Yes, there are. And you only do that when the price is overbought on the uptrend, which means the price has gone up, okay, and it's kind of like gone too far from the moving average, it would eventually snap back to the moving average. So again, in the stock trading course, in the lessons to come, I'll show you when is the point when the price is overstretched. It's kind of like a rubber band. When you stretch it too much up, it would snap back before continuing higher. So so traders who sell short over there, they are taking what is known as a counter trend trade, because you are shorting against the uptrend. But if you short over there, you have to quickly buy back over here to take your profits before the trend continues. Okay? So uptrends don't last forever. Eventually, uptrends would reverse into downtrends. So what's a downtrend? Downtrend is when the price makes a series of lower highs, as you can see, and a series of lower lows. So on a downtrend, prices go up as well for a few days or a few weeks. But every time the price goes up, what happens? It goes lower. It goes up, it goes lower. It goes up, it goes lower. It goes up, it goes lower. Okay? So on a downtrend, you never ever want to buy. You never ever want to hold a stock. So on a downtrend, the probability is prices will continue going lower. Price always follows trend. So on a downtrend, what you want to do? You always want to sell or you want to short during a downtrend. Okay, you want to sell short. So you make money as it goes down. So when is the best time to sell on a downtrend? Would you want to sell at A, at the high of the downtrend, or sell at B, at the low of the downtrend? Once again, would you want to sell at A or sell at B? Right? Obviously, logically, you always want to sell at the high of a downtrend, right? Sell high, buy low. So always sell the high of a downtrend, never sell the low. Okay? So again, the question is, how would you know it's the high of the uptrend? How would you know it's not going to go higher, right? So again, when we're shorting on a downtrend, we're looking for resistance levels. And again, the best kind of resistance to use would be moving averages. And again, I've placed some of the major moving averages, the 50, the 100 in this case, the 150, and the 200 moving average. So again, notice that price moves in wave patterns, right? It's on an impulse, it rallies, impulse, rallies, impulse, rallies, okay? So let me write that down. This is, again, known as an impulsive wave. So the impulsive wave is the wave in the direction of the trend. So the trend is down, impulsive wave is going down. And then we have what is known as a corrective wave, which is the wave opposite the trend direction. And in the downtrend, the corrective wave is also known as a rally. So you always want to sell the rallies of the downtrend. Okay, so again, the best time to sell is when the rally hits a moving average and finds resistance and continues going down. So you can see over here, it rallies, hits the moving average, goes down. Rallies, hits the moving average, goes down. Rallies, hits the moving average. That is the ideal time to short, to sell before the next collapse. So always sell the high. Never ever sell the low of the downtrend. Okay. Now again, are there times when traders or even investors buy during a downtrend? Yes, there are times you do that. When the price is oversold on a downtrend and you expect it to snap back up. So remember, it's again back to the rubber band example. When you stretch the rubber band too low, it's oversold, it will snap back. So notice over here, if it gets too low, it snap back. Too low, snap back. Too low. So when it's oversold, that's when traders would buy at oversold conditions. So you buy there, quickly, goes up, take your profit before the trend continues. Okay?